Socials. All right, here we go. Hello, Smart Money Tweak podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Agron. Hey, Doug.
Good morning, Kirk. How are you doing today? Happy Monday.
Happy Monday. Happy Monday. Little rusty this morning, but the markets aren't. So this will be,
Yeah.
this will be an
At least
interesting day, an interesting week.
I was going to say they weren't on Friday. I haven't looked at how they are rolling right now, but it looks like they still continue to be very excited about the fact that, as we say in the header of the show, we have a ceasefire and the war is over for the again.
Yeah,
and
war's over again.
the irony is everything going into the weekend and leading out of it is all about rockets.
Yeah, I know that is ironic, Doug. Yeah, it's well, for those of you who were not paying attention last week, Friday was a big day where SpaceX went public and did quite well. I think it was up 19% on the day. And trying to see if I can pull up a chart here, but it was a big boost on that day, and the markets like SpaceX, or at least Wall Street's version of the markets like SpaceX. And yeah, let's talk to you quite well. And a lot of people made a lot of money. And what's interesting is a lot of people don't understand how IPOs work, but when they come out, they have a release, and you can look at the financials and all the details, and it's pretty interesting to look through. SpaceX went public on Friday. You have Anthropic and ChatGPT, or OpenAI, I guess it's called, confidentially filed, I believe, last week, which means they'll be coming out probably in the next, probably by the end of the month, I would guess. And there have been some chinks in the armor of those, but SpaceX came out with good news. A lot of people wanted to be in SpaceX. Virtually all of them were in retail. Institutions were not touching it with a 10-foot pole. At least any of them I saw, they're not touching it. And it's interesting. So, I'm going to go over this. I think I went over this a little bit last week. I'm going to go over it again because I think it's really important to understand IPOs. So when I started in this industry in '99, IPOs are all the rage, and the way you got business from big clients is saying, "Hey, I have access to IPOs." That's what people wanted. If you got them IPOs, they gave you business. Now, what's interesting about that is I was at PaineWebber, and we were the small fish in the big pond. If you look at the top tier firms, there were top tier firms or mid tier firms. Top tier firms are like Morgan Stanley, Merrill Lynch. Trying to remember who else was back then. Those are the main two. And then there were the mid-tier firms like Tucker Anthony. And then there were some small big firms like PaineWebber. PaineWebber was in the top tier, but it was kind of a small version of the top tier. Prudential was, I think it was probably more mid-tier, but it might have been in the same boat. Either way, I was at PaineWebber. We were not getting a lot of IPOs. That went to Merrill or Morgan. And what's interesting at the time is because people wanted them because they went up like 50, 100% the first day, and then people get out. Well, after the first year, maybe the second or third year was in the business, they started to change the rules. And what they said is you can get IPOs if you held on for 30 days. If you didn't get access to IPOs anymore. So there wasn't a rule against it. It was more of it was one of those rules that they talk about in those commercials where it's not really a rule, but in the sales meetings, they go out and tell you to do all these things, even though you're not supposed to. It was kind of like that.
And if you do it, you're done. You'll never be invited again. So
yeah. And yeah, basically the thing is you get access to the IPOs. If you dump them within 30 days, you will not get access to any future IPOs. Basically, you're at the back of the line. Because obviously, if you can sell them and nobody else wants them, that's fine. But in general, you're at the back of the line. So that's not it's not ideal. And so you kind of did what you're told, and which is fine because if you sold good IPOs and it was it didn't matter. And they changed the rules up, and then people became a lot less interested in IPOs. And few companies went Dutch auction. But the interesting thing to note is that IPOs have not been really a big deal with certain exceptions over the years. Mainly tech companies have been the exceptions. Otherwise, people don't really care because you're not getting the same alpha generation that you used to get back in the 90s when just things would just shoot up in the first day. So
look how that worked out.
Right. Well, so the thing about IPOs is it's all about the fanfare. It's all about the sell the news. So think of it this way. I've got a company and I want to take it public. Why would I take it public? Well, I would take it public because I want access to capital markets. I take it public because I want more liquidity in the stock.
You want more control of how you run your company?
No.
Oh, that's not it.
No, that's the opposite.
Because you're doing it to make your life easier. That companies go public because they want to help their company.
Yeah, that's the opposite of what I'm saying, Doug.
Oh, sorry. Which is leading up to your point.
Right. So, to Doug's point, you bring the company public because you want liquidity, because you want to raise capital. There's a lot of reasons why you bring a company public. Now, when would you bring the company public? Well, you bring the company public when it's most opportunistic, i.e., the company that people are willing to pay for is a lot higher than it's worth. So if the company's worth $10 a share and somebody's willing to give me 50, done, right? I mean, my partner and I had a joke last week. We were talking because we're not looking to sell our company, but I was like, if somebody gives me like 100x what it's worth, done. You're done. You take it. I'll go figure out what I'm going to do next. But the reality is, if somebody's going to pay you an obnoxious amount of money, take it. Take the money, right? Don't be stupid. Take the money. And so a lot of these companies do that. And you got Elon Musk who said, I will never take SpaceX public. He said that. And so of course he did, but he said that a few years ago. He's like, I'm never taking this public. Okay. Why did he take Twitter private? Because he didn't want us to deal with public backlash. There's a lot of things that people can do, and for specific reasons, right? Now, if Warren Buffett was had a private company, you want to take the company public, would you buy it? Hell no. If Warren Buffett's selling, I'm not buying, right? I mean, but that's how you have to think about it. These people know a lot more than you. They're in charge of the company. They know things that you don't know, and they're taking it public, and you want to buy it, right? If you can't spot the rube at the card table, it's you. That's the truth of it. Nobody wants to hear this, but that's the truth of it. So, why would you buy a company that is clearly overvalued right on the first day? Is it because you feel like you're never going to get the stock again? Because the reality is, if you look through the financials, this company is way overvalued right now. No, not saying it's not a bad company. I'm not saying it's a bad company. I happen to like SpaceX. A lot of people like SpaceX. Not at this price. So there's two things you have to consider. One is, do you like the company? And the other is the price. I will buy any company out there at the right price. Now that price be maybe near zero, but there's always a price you pay for something. The problem is we are so willing to overpay for things that other people are willing to just give us at a high price. I am unwilling to overpay for SpaceX. I think it's a great company. I think there are a lot of great companies out there. It doesn't mean I'm buying them, right? NVIDIA, great company. I'm not buying it here, right? You got all these here's another example. What happened last week? Google raised, they sold equity into the markets last week. I think it was like 80 billion or something. It was some big number that they sold. They sold shares onto the market. Why would they do that? Because it was overpriced. So these companies are smart. Some of them are run by dopes, but they're smart companies, right? They're not run by all idiots. The CFOs are typically very smart. So if you look at some of these companies, why would a company sell equity? It's because it's overvalued. I don't know if you remember, I think it was AMC. It was either AMC or GameStop, one of those two meme companies.
Both of them fell into the meme.
No. Let me tell you what I was going to say first. They're both meme stocks, but one of the companies I believe a few years ago when you were having a lot of energy going into the company, and they sold shares, they sold equity shares, and that reduced the volatility of the stock. And then they sold equity shares again, and it kept reducing the volatility of the stock, because what they were doing is they knew the stock was overpriced, and they sold stock into it. They said, hey, if you're going to buy it, here's some shares. I'm going to raise capital. And then what they could have done, I know they didn't do this, but what they could have done is they could have taken all that cash and paid down their debt. Now, a company that was many hedge funds thought was going into bankruptcy, and based on the numbers probably was, until the meme stock candidates, they sold all the equity, got the cash, and then they could have paid down all their debt. And they would have been debt free. So as long as the company's cash flow neutral, you could run that company forever. Now it's a buggy whip company. It's eventually going to go away, because who's going to movie theaters? Generation X and boomers, I guess. But I did see a movie last week. It was The Mandalorian, which I thought was a good movie, but it was they could have easily put that on Disney Plus as an episode of The Mandalorian. I didn't think it was worth paying a movie's price for it, but it was nice to go to the theaters. Anyway, so Google put their shares out last week and raised a bunch of cash. When you start to see stuff like this, it starts to feel like a bubble, like the late 90s territory where we had the IPO bubble. I'm not saying that's the case. I'm saying it's starting to feel that way. All these signs point to the same thing of you better be careful. Now, right now, we have 2 more IPOs coming, Anthropic and OpenAI. And based on what I'm hearing, which OpenAI was trying to get, I think what were they trying to do? They were trying to, I forget it was, who was the guy? It was, I can't remember the guy's name, Sun. He runs a company that's basically venture capital fund. And I'll get his name when Doug talks. But anyway, so what he did is he tried to borrow money against his shares of OpenAI. He tried to borrow, like, I forget what it was, like 80 billion off of his shares of OpenAI, and he couldn't raise capital. The banks wouldn't give him money. And he tried to raise a lower amount. They wouldn't give him that either. And what that means is banks are very squirrely about OpenAI's valuations. That's what that means. It means banks are unwilling to lend off of their shares. Even though the shares are going public, they're unwilling to lend off of them. That's not a good sign. Banks are risk managers. They tend to focus on how can I reduce risk in this transaction? And they're unwilling to take the risk even at a very reduced valuation, reduced based on what people think it's going to go public for. So those aren't good signs for AI companies, primarily LLM companies. But that's very different from SpaceX. SpaceX went public, raised a bunch of money. It went up 19% the first day. I'm going to share this. I'm going to share the stock price if I can get it once Doug's talking. But in general, it's something to think about, right? Think about, do I want to own companies at a rich price? And I'm going to let me show you this. There's a handful of companies here I want to share with you. I'll hand over to Doug. Okay. So this is Uber when it went public. Okay. Company goes public. It jumps up. I think it was up, I don't know, looks like 20% first day. And then it went down, and it basically went sideways and then went down for a while. Okay. Then it went back up, and then it went all the way down. What happened in this drop right here? Well, that happens to align with the 6-month mark. What happens after 6 months? That's when all the employees are allowed to offload their shares. So what happened was Uber went public. It lost interest for a while. It went up, and then people started to sell because they're like, oh my God, this is the 6-month mark. We need to get out of our shares. They got out. Everyone sold. They cashed out at a very reduced price. It looks like 66% drop at the most. And then it went back up to the price and just kind of hung out there. and then it started to take off, whatever, year and a half later. So this is a normal cycle for many, many IPOs. Now, here's some other examples of some IPOs that you might know that didn't do so hot. All right. Here's the first one. Here's Meta. Meta hit a peak of looks like 45, somewhere thereabouts, and then came down, quite a bit. Came down to somewhere around $17 at the low, and then they announced a revenue model, I think right around here, and then it started to go up again, and then of course it came back, but it hit a peak of 45 and went down 70%, somewhere thereabouts, and hung around somewhere around down 40 after they had a revenue model announced. That was Meta. Okay, obviously Meta's done quite well since, but this is the first year of the IPO. First year of Coinbase came out, went down. I didn't have too bad I didn't have the dates here, but went down for a while and then came back and kind of hung around. So if you're going to buy on the IPO, would you rather buy in the IPO or would you rather buy it when it's, I mean, this IPO is at $350. It went down to $35. That's a 90% drop. Would you rather buy it at $350 or $35? Next example, Robinhood. Robinhood went public right around 40, right around, I can't see this arrows in the way. Call it 35, right around 35. And then it went down to 7. And then it obviously went up after that. So very frequently comes out, goes down a lot, and then shoots back up, right? And these are companies you know. There's Uber, talked about Uber, and Rivian. I don't follow Rivian. But anyway, here's another big company everybody wanted a part of, right? Electric car company. Went up, peaked out at like 180, and then went down to $11. Or actually went lower, went to $9. So now there are companies that came out and did well right away, like Google's an example, just kept going higher. But the point being is, I don't think Google was overvalued because I think at the time tech was out of favor and Google came out at a reasonable valuation, I believe. I'll have to go look it up when Doug's talking. But point being is IPOs are not all sunshine and roses. There is usually a good time to buy an IPO when people don't want any part of it. And that may be coming up over the next 6 months. I would be looking to buy in 6 months when all the employees are looking to sell. And I hope they do. You can get usually a pretty good price from that. And if the stock does not go down from here and just kind of hangs around, I would wait for that 6-month marker. I think based on the valuation, I'd be very surprised if it keeps shooting up from here. It's already way overvalued. And if people thought they could get a higher price for it, then they would have had the IPO price a lot higher. But the fact is retail wanted it. Even at Schwab, we had these pop-ups coming, hey, buy your SpaceX IPO. I can tell you first rate that if you have a company that is sold out where everybody wants shares, you do not give it to retail public. I'm just saying, doesn't happen. All the good stuff goes to institutions or the very, very best clients in retail. They're not advertising that they're just giving out to everybody. It just doesn't happen, especially for such a small float for SpaceX. They did not bring all of their shares public. It was only a very small percentage. So just note that there's a lot of gamesmanship going on with this IPO. And I do expect that we're going to see some interesting things over the next 6 months. What are your thoughts, Doug?
Well, feel free to go on vacation for the rest of the show, because I got plenty. Here's one thing well, first of all, I did want to come back to your comment on AMC versus GameStop. Great point. GameStop took that same opportunity. They sold off more shares. They paid off all their debt. They're sitting on billions of dollars right now. Now the CEO of GameStop is now getting all excited and talking about deploying that capital into 100 different ways, which will probably end up destroying their future because he sees the money, he's got the money, and now he sees all of these wonderful lucrative opportunities to blow it. AMC, was the exact opposite. That's the one you're referring to. They had the opportunity. They didn't pay down their debt, and they're still absolutely hemorrhaging. I want to start this by saying, here's what I'm actually changing the name. I don't know. You're Generation X, so you probably remember this when we were younger. So it was a term that it was a very nice term, but we used to use the word spaz. I don't know if you remember that.
I haven't heard that term in a while, Doug. Spaz. Yes.
Spaz. Generally apply to overly excitable, hyperactive kids, from kids to kids. Yes, it is probably not PC in today's world, but I've heard it, directed at me once or twice, so I can say it as the victim of those words, and I'm fine with it. Listen, I'm changing the name. This isn't SpaceX. From now on, I'm calling it SpazX, because I think that's exactly the way the market is looking at it. But I want to say a moment of I want to share a moment here to feel sorry, because with the new revelation that we have the world's wealthiest individual ever, now officially in inflated dollars has passed. I forget the name of the ruler from millennia ago that was, I think, Indian, from Asia. But anyway, when people have done calculations of the Rockefellers and stuff, they've calculated that in inflated dollars, this was the wealthiest person ever. And Elon has finally passed that. The name is escaping me. But who I feel sorry for is the next 9 people on the billionaires list, Kirk, because at least according to this article that just came out that I'm going to share here, and I've just put it over, Elon Musk's $1 trillion fortune is so vast that now Jeff Bezos is closer in wealth to the average American. So he's going to have to start readjusting his expectations, his lifestyle, in order to start to make some financial decisions the way the rest of us do. Because clearly now he's been pushed down to the masses, and so has Larry Ellison, because Oracle stock has dropped, and Bernard Arnault. All of these individuals now, Kirk, are going to have to start living a more humble life because of Elon Musk. So I think we all have to sit there and have a moment of just solace for, the new reality of these other billionaires and how they're going to have to change their lifestyle now that we have the world's first trillionaire. So, sorry, sorry, Jeff, and all of those other billionaires there. It's just going to be a new world for you.
How will they ever get by, Doug?
What'd you say?
They're gonna have to really tighten the purse strings here.
They are, and if they want to get in on the SpazX IPO, if they did, they probably were in the ones from Fidelity that were buying the $2,000 shares. Well, going back to your point of why would you take an IPO and push it down to $2,000 a share, or I'm sorry, minimums to buy in? That is not a bullish sign, right, by any means, because if they had enough money coming in from the top, they wouldn't need to all of a sudden open it to retail like that. Here's the thing that I've got so many different things to think about here. First of all, let's take a look for a moment of the SpaceX or SpazX valuation. It's like an aerospace index. The valuation of SpaceX coming out of the IPO was $1.75 trillion. That is the equivalent of an aerospace index of GE Aerospace, RTX, Boeing, Airbus, Safran, Honeywell, and a handful of others that only value at a total of $1.74 trillion. This is one entity, and this entity is got, it definitely has. I think it's a mixed bag, because it definitely, it has some significant positives in it. And I think that, from an aspect of the breakdown of it, it is actually internally got some things that are running really well. So I want to be a bullish case for a second of where, SpaceX could go. First of all, Starlink, this is the part that most people miss. It's actually an operating business producing real cash flow. It's reportedly profitable. It's growing rapidly. It's subscription-based. It's global. It's very difficult to replicate. Huge moat around it. That is a huge distinction. And historically, space companies burn cash dependent on contracts, promise future profits. Starlink is actually generating recurring revenue today. So, SpaceX isn't being valued like a rocket company. It's being valued more like a telecom company, a defense company, a launch company, all rolled into one. Rockets, surprisingly, are not the problem. The rocket losses appear surprisingly manageable, actually, relative to the scale of the investment. I mean, launching rockets it takes huge capex. The market expected SpaceX to be a perpetual money incinerator. Instead, launch costs have actually fallen dramatically. The reusability is working. At least for Elon, it's not working so much for Jeff Bezos. The margins have improved.
Low blow, Doug. Low blow.
Well, I mean, again, we're talking down to the masses here, and they're just going to take some licks. The launch frequency has exploded. It's amazing that, the amazing thing is that SpaceX launches rockets. It's the reusable rockets that actually become a business. Here's the problem. If you took just the rockets and you just took Starlink, this would be a wildly profitable company. Okay, even the operating losses of the rockets would be overshadowed by the profits from Starlink. But now there's X and XAI. This is where the conversation turned, and I think this is the part that people are missing that are jumping in on this stock. If SpaceX is the crown jewel, X may be the opposite. Let's be honest. The X acquisition has never really worked financially. Don't get me wrong. I love it. It is the news source for the world now. But advertising revenue remains well below pre-acquisition levels. Estimates are still that they're still 30 to 40% down from when Elon acquired it. User engagement may be up, influence may be up, political relevance may be up, but financially, it's still a challenge. And then on top of that, XAI arrives. And suddenly you've got data centers, GPUs, energy infrastructure, talent wars, all requiring staggering capital. So some investors are beginning to ask, is XAI the future? Or is it a liquidity vacuum? Because AI is incredibly capital intensive, more so clearly than the rockets. Unlike software, it requires chips, electricity, data centers, constant reinvestment. Spending never really stops. AI isn't software. It is all about infrastructure, and infrastructure is massively expensive. If SpaceX is public now at a multi-trillion-dollar valuation, and it gives Musk something incredibly valuable: liquidity, not cash flow, liquidity. Remember, he borrowed billions and billions to buy X, as they all do, right? But and he kept it private because, as we started at the beginning of the show, it is absolutely not something that you wanted under a microscope of analysts every single quarter. But if he can package this under something exceptionally lucrative, like walking past the display window of a candy store, hide it in there and get everybody to rally. This is Musk's liquidity exit for all of the investment that has gone into AI, that has gone into purchasing X, and that will go into it in the future, which means collateral, borrowing capacity, financing flexibility, and the ability to support other ventures. So now the question is SpaceX being used to fund the next phase of Musk's empire? It's not necessarily bad. I mean, Amazon funded Amazon Web Server, and that's been basically their profit center. And Amazon Web Server then later funded Amazon. Tesla funded other ventures. Capital moves. But investors need to recognize the strongest business in Musk's ecosystem right now may be SpaceX and Starlink. The weakest financial link may still be X, and the largest capital consumer is probably XAI. And if SpaceX is worth 1.75 trillion because it combines aerospace, telecom, defense, and infrastructure, then what is X worth? And what is XAI worth? Are these valuations being supported by cash flow or by SpaceX's success? So ultimately, there's a lot of story. I mean, the other thing to think about too in the IPO world that's coming up, because if we get into a situation now where where SpaceX, has come out, now you look at OpenAI and Anthropic. Okay, what does this mean? What does this mean? Well, SpaceX isn't the story anymore. FOMO is. The most interesting thing I saw coming out of this weekend was the reaction. The retail investors poured immediately. As you said, roughly 19% up on day one, reaching a valuation of about $2 trillion. We've gone from will SpaceX IPO succeed to how much future are investors willing to prepay for. Rockets don't create $350 billion of value in one day. As we've talked about countless times on this podcast, stocks are emotional. Investor enthusiasm is what is driving this. But here's a bearish outlook, I think, of what you're talking about there's a reason that mega IPOs are often considered a late stage, market indicator. Okay. First of all, mega IPOs, huge liquidity. If they can't get their money elsewhere, if they're not being able to borrow like you were talking about, and banks won't touch it, they use these IPOs as basically a last ditch effort to raise a ton of capital. Because again, nobody takes their company public to enjoy it. It is a nightmare. We live in a world where everything you try to do as a company is now under a microscope and assessed and analyzed and critiqued quarter to quarter to quarter. We do not live in a world now, especially with the barriers of entry of the markets having been removed over the last decade. We don't live in a world now where you can really make any long-term investments if you're public. It is constantly, what are you doing for me lately? So mega IPOs, if we start to see these push out as we are, and we see a massive spike in them, on the table to come, it is absolutely a sign historically that they need to get liquidity, and this is how they're going to do it. But I've talked about the M2 money supply, drifting back up. Mega IPOs can actually be an incredible liquidity drain. It ultimately, not everyone is worried about SpaceX itself. They're worried about what comes next with OpenAI and Anthropic. You're looking at potentially trillions of dollars of new market cap seeking capital. Money doesn't magically appear. And if the investors buy the shiny new object, question becomes, what do they sell? The biggest risk, and we started to see, there was this worry of what are they going to shift their money out of, to be able to buy into this. So the biggest risk to, and we've talked about the weighting of the S&P 500, Mag 7, the biggest risk to the S&P 500 of the current Mag 7, maybe the next Mag 7. I want to talk about the trillionaire thing, come back to that. The first trillionaire really does change the conversation. This is bigger than Elon. This is, and oh my gosh, it is just nauseating listening to all the people jump on the bandwagon about, it's not, if Elon Musk has $1 trillion and he gave this money back, look what we could do right now if we just took this wealth and we're $38 trillion in debt as a government. We've already proven if we take the money, and by the way, he paid $11 billion in taxes in 2021. Where did that go? This argument, this pandering to what I call on the political side, the woe is me envy vote. It's like, oh, he doesn't have trillions of dollars sitting in cash sitting around. I mean, of course, after liquidating here, he possibly could. But the point is, they've proven with $38 trillion in debt, they wouldn't know the first thing about what to do with it. The world's first trillionaire arrived because investors collectively decided future cash flows from space, AI, telecom, and infrastructure were worth over $2 trillion today. And this may be the defining symbol of the AI space era. It's not a wealth story, it's a belief story. And I also want to stay on this, in terms of the money. Oh, yeah, he's got $1 trillion sitting around, which he doesn't. But they forget for how many. We just made 4,000 millionaires in his company. And that doesn't include the countless, billions of dollars of taxes, both present and future, of capital gains, payroll taxes, federal taxes, all of this, you're going to have wealth taxes again, because a lot of people, including the billionaires, although they have lots of tax strategies they can use, passing this on to the next generation, also, the future is going to result in taxes. It's an unbelievable oversight of the amount of wealth that has been generated into the economy that wasn't there 15 years ago. And they have made money on this. The government is absolutely this. Again, it is creating money and creating wealth, creating opportunity. Now, will that stay? Who knows? Now, I want to move on here because we've got the Iran deal, the oil collapse. The markets, other major story, markets are clearly reacting positively to the parent Iran agreement, reopening of Hormuz. Oil has dropped sharply over the weekend on this news. Again, why does this matter? Well, a month ago, we had Iran and inflation risk. Today, now we've got Iran equals deflationary relief. I can't keep up. Fastest way, though, to lower inflation is still to lower energy prices. If we can get petrol prices down, everything we use, everything, including our food, unfortunately, contains byproducts of petrol. It's in everything. But the biggest thing, in my opinion, that's going to be a major benefit to the economy is going to be if we can get diesel back down, because diesel, we still use it for our trains. We still use it for our semis. Diesel, we use it for our ships. Diesel's behind everything. Diesel prices being high is absolutely a drain on the economy. Another thing to look forward this week, Kevin Warsh. I want to move on to that. We've got, honestly, it may turn out that SpaceX is last week's story. Warsh may be this week's story, Kirk. The market now is going to pivot towards the first Fed meeting under the new chairman. We're going to have to see what happens there. The market wants lower inflation. Wonder why all of a sudden we might be getting an agreement with Iran. We've said this for a while. The administration needs lower inflation. The administration needs lower rates. The market wants this. We're going into midterms, higher growth. History suggests you rarely get all three. The Fed may be the only thing standing between euphoria and reality, right? Consumer sentiment, because of this, has improved. It's a sleeper story with these gas prices falling. Consumer sentiment, hey, look, it's cheaper at the pump. They're very correlated. Overall sentiment does remain historically weak. People feel better, but they don't feel good. They're relieved, but they're not confident. And one thing I want to say this and throw this back to you. And by the way, there's a massive chart crime I want to get to before we close out the show today, but I'll turn it back to you and then come back to it. I think it's hilarious with between AI, but a thought for you, Kirk. What if SpaceX is the new Cisco? I mean, Cisco changed the world, right? The internet happened, Cisco won. Now the stock didn't necessarily reward late buyers. And the same thing possibly could happen here. And by the way, going back to your 6 months later, 66% of IPOs were actually negative off of the IPO price 6 to 12 months later. That does mean that 33% were able to come out of the gate and stay high, but it does mean that the odds are exceptionally high that the price, especially where it's at, we're talking 30 years of expected return, and it isn't going to be able to return that immediately, is being priced into it. But what if SpaceX becomes everything the bulls think it will become, and yet investors still overpay? What are your thoughts on that?
Yeah, I think we're in interesting times right now, and if I look here, I'm sharing what happened before the market opened. The market's open now, but this was what the futures markets were looking like coming into today. And this is because of the news announcements that the war ended again. And so, looking at this, equity markets are looking good. Oils and energy prices are down. Bond yields are dropping. Gold and precious metals are doing well, and currencies, looks like Bitcoin's doing well. So that's, off the cuff, this is good news, right? Now, is that news going to continue? I have no idea. um, I think we're in an interesting situation where the quote unquote good news came out 2 months ago when Trump announced the war's over, and now the war's over again, and it seems like the terms were really bad for the winner. Yeah, you guys can just do whatever you want. I haven't read all the terms, but everything I looked at was kind of like, wow, you agreed to everything that they wanted? Good for
Hasn't that been
you.
the case for the last 50 years, 60, 100? Yeah. Anyway.
Wow, you can keep your nuclear program. We're going to pay you money to reconstruct. We're going to like, wow, did they win or did we win? It was unclear from the terms who won that war, but or military conflict. Sorry, it wasn't a war. But to me, it just looked ridiculous.
I just shake my head, man, because we always, and I know we're not getting political, but all this will do is embolden the regime. Anyway.
Yeah, well, let's not get into the politics of it. I'm just saying, just economically, right? We spent a lot of money. We gave a lot of money to the military contractors. Obviously, we're refilling their coffers because they ran out. And we went over there. We messed up a lot of stuff, killed a lot of people, and we didn't really get many results. It kind of leaves you scratching your head, like, what was the point? I'm not going to get into my tinfoil hat's too hard for me to reach. I'm not going to get into that right now, but let's just put it like this. I am still going to. I'm optimistic that this is it and that the war is over and the markets seem to really like it. But I would have thought the markets would have done better than this. But maybe it's because the war was over a while ago. Now the real question is going to be: is there confirmation? Is there follow through with this? Right? It's kind of like the SpaceX. It goes public and it goes up a lot, and then it flatlines for like 6 months. That's not confirmation, right? It's confirmation that you overpaid. Now it's burning itself off. So the question is: we're in the summer. June, July, August tend to be slow months anyway. We're in the summer, and we've got the war that's over, and what I'm very curious to see is what is the market showing you today? All right, so I'm going to read through this really quickly to give you an idea. When news comes out, what do you want to look for? Okay, so right now, the news came out that the war is over. The S&P is up 1.5, Nasdaq's up 1.3. The Russell is down. It's basically flat, but down 10 basis points. Oil's down like 4%. Gold's up 3. Silver's up 4. Bitcoin's up 1 and change. Ethereum's up 5. The Nikkei's up 3. The Kospi is up 5. The bonds, the yields are dropping. The dollar is down, 1/3%. So those are some of the big components to look at. Looks like Japan's up. Now, does generally good across the board, right? There's good results because virtually everything's up that you'd expect. Oil's down, you would expect that. The Russell's down a little bit. I would not have expected that. Dollar's down, that was expected. Okay. Now let's look beyond that. Let's look at the US sectors. Okay. We have the financials. The financials are up less than 1%. Energy sector down 3.5%. Normal so far. You have materials up a little under 2%. Okay. Industrials up a little under 2%. Staples down 1/3%. Utilities down a little bit. Healthcare down a little shy of 1%. And technology is up 3.5%. Discretionary is up 2 and change. Okay. So, looking at that, and emerging markets are up 2.5%. All right. So looking at those sectors, and I don't have the real estate sector in here because I don't really watch it, but and we also don't have communication. I'm not sure why, but anyway. But if you look at those major sectors, for the most part, it's what I would expect. Energy's down, totally expect that. Bond yields are declining, and the financial sector's up, would expect that, right? Materials is up, expected. Industrials expected. Utilities down. I didn't expect that. When you have bond yields declining, that means utilities should be going up in price. Um, Technology is always up, so I don't know whether to expect that or not. Healthcare's down, staples down. I'm not sure why. That's maybe a little unexpected. I would have thought across the board things would have been up. Industrials and materials up. Okay, I guess that's fine. So if you kind of look at what things have done, I'm still a little not confused, but I'm still a little scratching my head about like, all right, where are things going to go from here? Because some of this makes sense, some does not. Emerging markets are up. That I would expect. Now, the odd part about emerging markets is the fact that they were not down more during the war, because they're the ones that get hurt the most. Because emerging markets are, if you remove China, a lot of them couldn't pay their bills. Like, it was really a struggle there. And unfortunately, the big emerging market ETF, it has a lot of China in it, and China's been holding its own. So that's been keeping the world from looking a lot worse. But regardless, that is not a surprise. Commodity index is down, steel's up, copper's up. There's some question marks in here, but transports are down. Insurance is down a little bit. Yeah, I mean, we're seeing some really interesting stuff. Overall, it seems like an expected result. Now, the big question is going to be is what happens on Wednesday with Warsh. No one is expecting that interest rates change. So if they do, I think it would shock the world. Nobody's expecting interest rates to change. But I think people are going to listen to what he has to say because they want to hear the words coming out of his mouth. Now, I would expect the rest of this year. Now, going into this year, there was a rate drop expectation of three rate drops. And then with the war, people put it at an expected rate hike. I expect that rates are not going to change this year unless something drastic happens. I don't think they're going to change. Now, they might towards the end if inflation drops through the floor, but right now we just saw some high inflation prints. So we'll see. And based on the macroeconomic data, things are still a little hot. I expect they will be for the next quarter with earnings. I expect things will probably be a little hot. Expenses will be a little high. Transportation costs will be a little high. Inflation is a little high. I expect that maybe earnings this season is probably not going to be great. It's not going to be terrible though. We have pretty strong earnings. The consumer doesn't seem to care. And I saw actually I read a great article this weekend, and here's the thing. A lot of people have been talking about how income has not been increasing, but people's expenses keep increasing. And people have been concerned. Why is there such a discrepancy? Well, I think this person hit the nail on the head. It's easy because boomers have a lot of money. They've saved a lot of money and they're spending it. It doesn't mean that their kids are spending it. Their kids are sitting at home, living at home with mom and dad, and mom and dad are spending the money. Well, the kids aren't spending money on rent because they're living with mom and dad. But mom and dad have all this extra cash and they're spending it. And they're spending it, and usually income and expenses line up. But when you have a lot of cash and you can spend that cash, your expenses could keep going even though the income isn't. So that's, I think logically, that's the most likely reason why things are not aligned there. So I would not look at that indicator, even though a lot of people are, as a problem. I would look at it as we've got a lot of backed up cash in there from the boomers that have done a great job saving over their lifetime. And a lot of them are starting to spend and they're not earning the money, but they're just pulling cash out. And that's starting to impact the macro indicators. So something to keep in mind if you're concerned because people aren't spending, people aren't earning enough and all that. The problem with making predictions as a macro economist is there's so many moving parts, you're more or less guessing what the reason is. You can't know the reason. We don't live in an environment where you can test one factor. If we found a way to put together two parallel universes and it's like having twins and you experiment on one of them and see what happens and see the results, then that's a good test, right? If we could go back in time and say, all right, we tried this and let's try this and see what happens. Yeah, then you can determine what action determined the result. But the reality is you can't know. And there's no way to know. There's too many influencing factors in any sort of situation, especially complex situations, to know that, oh, well, this is the result of this. No, it's a correlation, not a causation. You can never figure out causations with complex systems. You can't. It's impossible. You can only guess at what the causation is, but you can definitely figure out correlations. And that's the closest thing we can come up with. It used to be that when stocks went up, bonds went down. When bonds went up, stocks went down. It used to be that was people thought, well, that was a cause because they're inversely correlated. No, they're not always inversely correlated. Sometimes they're positively correlated, like now. Like right now, they're pretty positively correlated. They have been for a while. It started back in 22, and we've had ins and outs, but right now stocks and bonds are relatively correlated together. So when that happens, you're not getting that inverse correlation. Is it causative? No, it's a correlation. And so it's something to keep in mind every time you see, well, if A happens and B happens, well, if we print money, gold's going to go through the roof. Not always. No, not always. It'll actually mess with your head more than you think, because that doesn't happen very frequently, right? If the dollar goes up, gold's going to go down. No, not always. They're correlations, not causations. Over long periods of time, maybe you could say it's causative, but I would argue against that. I would say it's not. There's so many factors that go in that you can't pull on one factor and say, well, this is going to happen, so X. No, that's not how things work in the markets. You truly never know what the cause is. You just have a bunch of people guessing what the cause is after the fact, and they say, well, this is the reason. I will say that I'm glad that the war is over for many reasons, but a main reason is it was really causing my prediction of the stagflation. It was starting to come true. All the things that stagflation leads to in the data was starting to line up with all the results from the war. So I'm glad that we don't have that because stagflation is an ugly beast and nobody wins. Nobody wins in stagflation. And hopefully that has taken a back seat and we won't have to experience that, because that is not something you want to experience. All right, Doug, final thoughts and take us home here.
All right. So first of all, I'll do this really quickly. So I know you love a good chart crime. So I saw this the other day. I'm sharing it. It was actually
it's having trouble. Why don't you just tell me which one it is? I'll pull it up.
It's the one we're talking about, the .com bubble versus the AI bubble. Do you see that one?
Yep.
Okay, perfect. So I was going to run through a couple different slides there, but you can start with the first one. So you can see that basically, this individual shows the .com bubble with the AI bubble. And then, the next slide starts to compare the drop off. And now all of a sudden, Palm IPO, which they're using as the example of the .com, is similar to the SpaceX IPO and talks about the Palm IPO having a 75% drop. And then takes literally in the GIF and overlays it over to the right and attaches it to the future of the SpaceX IPO, showing that that'll be a 75% drop. And ultimately, Palm and SpaceX are the exact same thing. So anyway, it's hilarious. It is chart crime in real time. Again, I think it's even funnier if you can watch it. But the funny thing is, he talks about the stock market crash in 1995. Well, wait a second. I thought that happened in 2000. Oh, what happened in 2008 in between? Totally skips over the two crashes that actually happened in the middle, and the fact that, I don't know, Palm wasn't actually putting profitable rockets into space. So I don't know. Again, we love a good chart crime. This one's absolutely brutal. As I wrap it up here, I just want to talk again, coming back lastly on SpaceX, and I think it's really important to understand and add more context. Why are insiders suddenly willing to sell? Okay. It's not a cynical question. It's a capital markets question. Bear case number one, the public is being invited to the party after the house was built. For years, venture capital, sovereign wealth funds, private equity, institutions, they all got access. Retail gets nothing. Now suddenly, retail gets invited at a $1.75 to $2 trillion valuation. It isn't as SpaceX great. It's why wasn't retail allowed at $100 billion? Retail investors often get access after the asymmetrical upside has been occurred. IPO number 2, IPOs historically transfer risk. Private investors take development risk, take funding risk, execution risk. Public investors, they pay for proven success, sometimes too much. Think Facebook, Uber, Rivian, Coinbase, Snowflake, Netscape, all great, at one point, great businesses. I don't know about Rivian. Questionable entry points. Wall Street's favorite trade is selling certainty. The bar gets lowered during euphoria. That's the number 3. Fascinating one to me. Every cycle, requirements start dropping. People stop asking, what are the earnings? What's fair value? What's the cash flow? And they start asking, how high can it go? When valuation discipline disappears, risk increases. This is very much like Kennedy. When I start getting stock tips from the taxi driver, that's when I worried. The easiest time to sell something is when buyers stop asking questions. Bear case number 4. Smart money often sells dreams to buy cash flow. Very important. Institutional money isn't always exiting, but they often rebalance. If you're a VC sitting on 50x gains, 100x gains, 500x gains, you don't have to think SpaceX is bad. You simply have to take chips off the table. Smart money doesn't sell because they hate the company. They sell because they love the return. Then also look at this as a liquidity event versus a growth event. An IPO is 2 things. It's a capital raise. It's a liquidity event. People focus on number 1. Bigger stories often number 2. Who's becoming liquid? Who's diversifying? Who's reducing concentration? It isn't just a buying opportunity. It's also a selling opportunity. As I said before, bear case 6, Musk's empire needs capital. It's where it gets spicy. Strongest cash generators, SpaceX and Starlink. Consumers, AI, XAI, X, and future infrastructure. It isn't being monetized because it is mature enough, or is it becoming because other ventures need fuel? Number 7, last one, smart money may be rotating, not chasing. What are institutions likely doing? They're not abandoning SpaceX, but possibly trimming, hedging, diversifying, reallocating. Institutions think in expected returns, not excitement. The retail continues to ask, how high can it go? Institutions ask, what's already priced in? Retail buys stories. Institutions buy expected returns. The smart money question, why are some of the smartest investors in the world willing to sell pieces of it? It's not because they're bearish. It's because at some point valuation matters, and the most bullish people in the world can still be sellers today because they bought at 10 billion, 25 billion, 50 billion, 100 billion. Look, they're now selling at 2 trillion. I don't blame them, but you got to understand as a buyer what that means. Smart money is not asking whether SpaceX changes the world. They're asking how much the future's already been prepaid. Retail investors are celebrating access to SpaceX. Smart money may be celebrating finally getting liquidity. So to close out today, I want to leave you with one question. It's not whether SpaceX is revolutionary. It's not whether Elon changes the world. It's not whether space, AI, robotics, autonomous vehicles, satellites, or communications are the future. They probably are. The question is, who is selling? Because every share that a retail investor is excitedly buying, someone is excitedly selling. And that doesn't mean they're bearish. In fact, they may be some of the biggest believers in SpaceX on the planet, but they bought when the company was worth 10 or 50 or 100 billion, and they're being offered liquidity at nearly 2 trillion. That's not a vote against the company. That's a vote for the return. That's the difference between investing and storytelling. The public's looking at what SpaceX could become. Smart money is looking at what already happened. And one side sees the future, the other side sees the valuation. Listen, both can be right at the same time. And that's why whether we're talking about SpaceX, AI markets, college planning, retirement income, or building wealth, the most important question isn't what's the opportunity. It's what is already priced in. At Emergent Advisors, we help families step back, see the entire picture. What's your income today? What's your income in the future? Are you using past income, present income, future income? Your assets, your liabilities, your taxes, college funding, retirement income. By the way, you could actually potentially save $200,000 to $400,000 in college just through strategies on how to pay for it. That is not just about paying for college. That's future wealth for other things, other goals, other lifestyle. Opportunities and risks that often get hidden behind the headlines. Real wealth isn't built by chasing every story. It's built by understanding the difference between a great story and a great decision. And right now, the market is chasing AI, space, possibility of, not possibility, reality of the world's first trillionaire. And distinction has never been more important. We could be at the end of a very long market cycle. We could be finally seeing the signs of culmination of multiple indicators coming to tell you this is late stage. And if you'd like a second opinion on your financial picture, if you want to see how your retirement income, how your future wealth is going to be through different markets, through inflation, through taxes, through many different risks, visit us at mergentadvisors.net. That's MERGENT, MERGENT, mergentadvisors.net. Because when everyone is looking up at the rockets, sometimes the smartest move is to look down at the launch pad. We'll see you next time. Thanks, Kirk.
Yeah, and thanks for coming on, Doug. And that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app you're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think, but investing. We're also not selling products or services, so do not consider this advice. If you have problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.